Hi everyone, this is Abhishek Kumar from Ingenetus Consultants and Provitt Private Limited. Welcome to our first audio blog, and I'll also like to thank all of you for liking our previous video blogs and also giving us your comments and your feedbacks on the video blogs that we have posted on our YouTube channel. We are trying to improve ourselves. We are trying to incorporate all the feedback that we've got, all the comments that we've got from you guys, and we're trying to incorporate that in our video and audio blogs. I'd also like to urge all of you to please subscribe to our YouTube channel, follow us on Facebook and on our Twitter handle. Uh, we keep on posting some news, some data on these three online channels whenever we feel they are necessary. We keep on posting some news or the other which can probably impact our investors or our clients in general, or the news that they should be aware of. So we keep on sending some data or the other on these YouTube, Facebook, and on our Twitter handle. So just subscribe to us. The link is there in the email that you have received. Now, coming to this audio blog, why we have chosen today to send you this audio blog is there is a US Fed meeting tomorrow, and where some decision has to be taken on the US Fed rates. And also, we wanted to just list down a few factors, few things uh, that you guys should be aware of. We'll cover the US Fed meeting as well in a bit. But apart from the US Fed meetings, we have listed down certain other factors as well, which can happen, which can impact, uh, but whether all of them will happen or whether some of them will happen, it's your guess is as good as mine. But to list down the factors, I thought that is important for all of you. So we have just listed down the factors of what we feel about the markets and the economy in general. So we are expecting the Indian markets to correct, and we are expecting the Indian markets to correct by about anywhere between 10 to about 15%, 16%. 10 to 15, 16% is the correction that we are expecting, and we are expecting this correction by the end of the fourth quarter, which is the December quarter, or probably the first quarter next year. Now, why we are expecting this correction is due to some factors. To start off with the first factor, we feel the banking sector in Europe is a bit shaky. So if I talk about Italy has a bad loan problem, and is expecting Germany to bail out. Um, but the issue is not that specific to Italy. If something bad happens to the banking sector in Italy, it will have a ripple effect. It will go to Germany as well and to other countries in Europe as well. Um, so that is a little bit of concern, which can blow out can blow out of proportion in the coming few quarters. And also due to this, coming to the second factor, this banking impact, due to this banking impact, safe haven buying will start, which is dollar buying will start, and it will appreciate the dollar by about 5 to 10%. And if the dollar appreciates by about 5 to 10%, then the Chinese yuan becomes worried. China needs to depreciate their currency. Their reserves have come down to from about 4 trillion to about 3.2 trillion, if I'm not wrong, which is about mid of next month, the last figure that I have. uh, so their reserves are going down, and if we know that a country has to depreciate its currency, then it's always better to depreciate the currency when you have the reserves to back it out, right? uh, so you depreciate your currency, and there should be the reserves of that particular country, which should, you know, give a support to that depreciating. So when I'm seeing the reserves uh, of China going down, I feel that they should depreciate their currency in the next 6 months, and it can be of the range of about 5 to 8% of depreciation. Now, if this Chinese depreciation happens, this will have again a ripple effect on the global economy. Like we had the last time. Uh, Hence, that is an area of concern for us. Then, thirdly, the U.S. presidential elections. If Donald Trump wins in U.S., the initial reactions will be negative. It will have a negative impact on the global economy, on the global markets. But we feel that that negative initial negative impact should, eventually correct, uh, because he also wants to spend on infrastructure, and if you need to spend on infrastructure, you need to borrow more, uh, which is in turn good for the global economy and the global markets. If I come to a geopolitical reason, which we are seeing is, the South China sea tensions between China and the other countries there, that can also have an impact. Uh, due to these factors, we are expecting a 10 to 18% kind of a correction, uh, which can happen by the end of the fourth quarter, the December quarter, or the first quarter next year. But this correction is all short term, and this should be seen as a buying opportunity. Why I'm saying that is because from April 2017, India should do well. India should do very well, because we are expecting the corporate earnings from about -2% levels should go up to about +12 or +13%. And in the subsequent year, which is 2018, we are expecting this corporate earnings to go further up to even 19 to 20% kind of a corporate earnings in 2018. Hence, if these corporate earnings go up, it has a positive impact to the market. uh, if a company is doing well, if a corporate is doing well, if the earnings are going up, the stocks of that company automatically goes up. And also it has a very positive impact on the valuations. So the price to earning ratio, the PE ratio of the market, will go down drastically. So the price to earning ratio, because the earnings are going up, the ratio comes down, and hence it makes the markets very attractive. So if I would say, a Sensex level of about 45,000 is not unrealistic for us. Not immediately, but in the subsequent years, we feel that a 45,000 kind of a Sensex level is not at all unrealistic. If you come to the interest rates, we are not seeing more than about 0.5% of a rate cut. I'm talking about the RBI, the Indian rate cuts, the repo rates. We are expecting about 0.5% of a rate cut by mid of next year, which should again impact the Indian economy in a positive way, because if the repo rates, the rates in the market, the interest rates goes down, the borrowing cost of corporates comes down, and hence it correlates to the corporate earnings story, which I just discussed. So because the borrowing cost of a corporate is coming down, the corporate earnings of a corporate becomes good, and hence the corporate or that particular company becomes more strong. So that 0.5% of a rate cut should have a positive impact as well. If I come to inflation, probably can go up in the coming times. Um, that is because, if we are expecting our country to grow, the demand should go up. And when the demand goes up, it is not necessary that the supply goes up immediately. When the demand goes up, the supply to go up, it takes a little bit of time. So in that particular time, because of that demand supply mismatch, uh, the inflation should rise, but in controllable limits. It should not rise more than what is expected out of the average inflation limits. uh, Global economies are struggling a little for growth, um, which brings me to the topic in hand of a Fed rate hike, whether we are expecting a Fed rate hike or not. uh, our internal view of our company is that we do not see a Fed rate hike happening in September or November. There are two Fed meetings, which there are three Fed rate meetings which are expected this year. One is in September, one is in November, and one is in December. Because the U.S. presidential elections are in November, we do not see the Feds, increasing the rate in September or even in November for that matter. December has a 50-50 chance. But so close to the elections, we have not seen Fed playing with the rates, and we don't see it happening this time either. We don't see a rate hike in happening in September or in November for that matter. Um Another thing is also the global economies are struggling for growth. Europe is sluggish, Japan is slow. So that can have an impact. On the rate hike decision as well. In case if that rate hike happens, with the probability of which is very less according to us, we can see a knee jerk reaction which can prolong to a few days, and also can go up to a few weeks. But that will just be a knee jerk reaction, not more than that, because this Fed rate hike is already been factored in by most of the global markets. This news has been going for a while now, and the markets have kind of absorbed already a Fed rate hike. So even if that happens, that will be a knee jerk reaction in the market, not more than that, and that should not go beyond a few days or probably a few weeks. So that's our view on the Fed rates. If I come to commodity prices will be low. We see oil settling between $50 to $60 per barrel, which will only help India because it will bring down the fiscal deficit and the current account deficit. We also see a big push in infrastructure in India, and also the subsidies going down, and all the subsidies have gone down, and any subsidies which are given directly, which has also benefited India. So that's in a nutshell of what we feel. We feel the markets should correct a little by about 10 to 18% in the coming 2 quarters, but that's just a buying opportunity. In a long term view, we feel that the markets should do very well. Indian markets should do very well. The consumption story of India is still very powerful. Uh, we expect good returns out of the Indian markets, and that returns we feel should start coming in by from April 2017. So we have the same view, of staggered investments into the equity markets through SIPs or STP routes, and balanced portfolio probably, with a mix of little bit of of debt market as well, of debt funds as well. Right. I hope this was an informative audio blog for you guys, and we helped you somewhere or the other. Do we do keep on providing your feedbacks and your comments. We really look forward to that. Thank you so much, and till next time. Bye bye. Take care.